per bit consumption of data decreases, the more data flows onto the platform. So that's an important concept to remember about technology is growth in usage does not equal the same amount of growth in revenue.
Let's talk about a couple of other companies that we are going to reallocate that cash to. Hey everyone, welcome back to Chipstock Investor. Today we're going to be talking about a stock that we recently added to our portfolio, a software company that we finally decided to add after many years of just watching it, Snowflake.
Yeah, let's talk about it. And more importantly, why we're very quickly course correcting and exiting that position. And maybe I should say first, it was a small starter position. If you're trying to follow what we do closely, you may know that a starter position for us is far less than 1% of our portfolio, usually less than 0.5% of our portfolio. And it tends to be more like an earmarker so that it forces us to keep tabs on what's happening with the business. So we've been keeping tabs on what's happening with Snowflake even more closely and not liking what we see.
Exactly. And the reason we're putting this video out now is it's something that we've been discussing over on our Discord channel. If you would like access to that, make sure you check out our Semiconductor Insider membership. That gets you access to our Discord channel, as well as all of our show notes and video notes. Link to that in the description. Nick, let's start by looking back at a timeline of events for us with Snowflake. And to be completely honest, I don't even remember why we bought Snowflake.
Okay, totally fair. If you don't know why we bought it, I'm reconsidering why we bought it. We probably should have never even bought it in the first place. But this is the timeline that you made back in March and that we shared, generally outlining our coverage of Snowflake since the IPO in 2020. We've gone from absolute absurdity surrounding this business and its valuation and us scratching our heads at what people were thinking, buying it, to more recently thinking, okay, Snowflake's valuation continues to get more reasonable. It seems like, yes, their growth trajectory is slowing down, but they are making positive progress. And in this new era of AI, especially with AI training requiring so much data to train these new pieces of software, Snowflake certainly has a very clear use case. Obviously, it still isn't a cheap stock. That wasn't the reason why we finally nibbled, but there was another sell-off early this year. Here's our assumptions on what makes this thing a fair value today at roughly at the time between 150 and 160 per share. As we write and record this after hours on May 29th, we're below 150 per share. The assumption was we're going to get free cash flow per share growth rates of about 20% for the next 3 years and a terminal growth rate of 8% thereafter on free cash flow per share. And that assumption only works if the company, of course, continues to grow revenue. Revenue is decelerating. We'll talk about that. Profitability needs to get better. And suddenly, management is downgrading its assumptions for profit margins. So that's what's causing us to rethink this. Let's maybe zoom out and talk about where Snowflake fits into the hierarchy of the economy before we continue.
If you haven't watched it yet, go back to a video that we'll link here and in the description on how AI has changed everything. And we talked about this chart that we have, the hierarchy of the economy. On the left side, you see the traditional older economy where commodities like energy, oil, any other base materials are turned into products and services. And now in the economy that we live in, that's still true, but everything has migrated more towards that right side where digital data is everywhere we look. All of that data is now a commodity and being used to make software products. And that is where AI is helping with creating new use cases for all of that data that we have in literally everything.
That's right. And in that video back in March, we discussed how even some of the older, more tactile part of the economy, even that type of product and services are actually becoming commoditized as well and turned into data. Definitely check that out. But in the wake of making that video, one of the things we thought about was we have this new merging of the old economy and the new economy, everything getting turned into data and eventually flowing up into new products and new services. And these can be just as tangible products and services as in years past, or it could be very IP heavy software based products. It doesn't matter. Data is a new input into creating higher value products and services. And frankly, really, really profitable products and services. Where does Snowflake fall into all of this? It's a data management platform. So we can kind of categorize it here towards the bottom and towards the middle of the hierarchy of the economy. Think of it as a type of software infrastructure for businesses, enabling them to make proper use of all of that valuable data that they may have on hand, but they're still trying to figure out how to monetize it, how to unlock value from that data. That's essentially what Snowflake does.
So, really, we rank Snowflake as a type of data commodity and infrastructure software provider, as Nick said, and there can be tremendous value in this type of business. Snow continues to help visualize this with cloud based digital data growth since 2020. You can see that bottom footnote there says that visualization is based on actual AI data cloud sharing activity as of April 30th, 2020 on the left and April 30th, 2024, respectively. And ultimately, we know this is the case with all of the hype surrounding AI has grown immensely in just the last 4 years.
Exactly. And as with any technology, obviously we're getting exponential growth in the actual amount of data on the Snowflake platform. That does not equal revenue growth. Per bit consumption of data decreases the more data flows onto the platform. So that's an important concept to remember about technology is growth in usage does not equal the same amount of growth in revenue. So that's where I think there's maybe some misleading information about why Snowflake is a good buy. It does not automatically translate to growth for the business itself if this chart, this representation of cloud data continues to just exponentially rise. This is the problem with any commodity based service, even in the old tangible economy. At any rate, to your point about this being enterprise software, they have taken this unified platform that started with just optimized storage of cloud data and have progressively added more value add services on top of that. So, ways for companies to migrate their data around. And then in more recent years, the last year or two, they've been adding more ways to actually use the data within the Snowflake platform itself. And now we have this whole Snowflake marketplace with data-based applications, big data-based applications, including artificial intelligence and increasingly generative AI getting built on top of this data that Snowflake helps its customers store and manage across multi-cloud platforms and across their own enterprise, private network data storage facilities.
Let's talk about the business model for Snowflake, how they make revenue. They have a consumption model, as you can see, versus something like a subscription as a service. You can think of that more like Netflix. You pay a certain set amount for that subscription and watch as many videos as you want or as little videos as you want. But Snowflake actually is a little bit different. It is truly a data commodity business model. Customers that use more data and do more stuff with the data get an increasingly cheaper cost per bit of data and compute power. This pricing model has definitely been working. You can see that the company is on track to exceed 3 billion in revenue this year. Snow exceeded expectations for their Q1 fiscal 2025, which is the 3 months ended in April of this year, 2024, with product revenue increasing 34% year over year and total quarterly revenue increasing 33% year over year. Fiscal year 2024 was a 36% year over year growth, and management did raise the guidance for full fiscal year 2025 with the product revenue That is expected to be up 24%. They had a 22% guide before this last quarter. Let's talk about a problem that we see that has us rethinking our taking an initial position in snow.
Yeah, and it's not just the decelerating growth. Remember, if they're expecting full year revenue growth of 24% now versus 22% before, which is what this slide is, we're going to talk about 3 months ago at the last update, and when we talked about this in March. To get that average, full year average of 24% growth, that means exiting fiscal year 2025 by January of 2025, they're probably reporting revenue growth of 20% or lower. Okay, fine. But the real problem is along the way, if you have decelerating revenue growth, you should have increasing profit margins. That's what the market absolutely needs to see right now. This particular market where we have a higher interest rate environment, it's okay to report slower revenue growth, but you better be reporting increasing or at the very least stable profit margins along the way. So this is 3 months ago. Adjusted operating margin was expected to be 6% for this fiscal year. Free cash flow of about 29%. Fast forward to today, management has downgraded adjusted operating margin down to 3%. So they've halved it from 3 months ago. And then along the same lines, a 3 percentage point ding to free cash flow from 29% down to 26%. What that means is all of a sudden, Snowflake has not just slowing revenue growth this year, but also contracting profit margins compared to the last couple of years. That's not a great look for this current economic environment we're in.
So that begs the question, why are those profit margins going down? Take a look at this quote from CFO Michael Scarpelli. He said that they are lowering their full year margin guidance because of increased GPU related costs related to our AI initiatives. GPU related costs? Let's talk about that. Is that Nvidia? Spoiler.
Yes, it is. A Snowflake, like so many other companies, having to pay the Nvidia tax. Yes, it's a software business. It's an enterprise software business that helps companies with their data storage, but that doesn't mean Snowflake has no hardware whatsoever. They have to roll out new AI software products. They have to do some training. And so that might mean purchasing some NVIDIA AI servers themselves so that they can train some new product. It also means that they're going to have to go out and work with some of their cloud-based infrastructure providers, predominantly Amazon AWS, to a lesser extent, maybe Google Cloud and Microsoft Azure. Either way, though, these companies that provide the actual cloud infrastructure that Snowflake runs on are investing very heavily into NVIDIA accelerated compute infrastructure. And so some of those costs are ultimately going to trickle down to Snowflake. Now, NVIDIA shows this graph a lot about how their GPU powered accelerated compute systems have reignited exponential growth in computing power. Awesome, fantastic for the end customer. But for a company like Snowflake that's maybe caught in the middle, this means some short to intermediate term pain because they're going to have to pay the cost to install and begin using that infrastructure to ultimately deliver the better product and the better service to customers at the end of the economic hierarchy, at the top of the funnel.
That makes a lot of sense. You have to stay competitive. Otherwise, you lose customers. All of that competition requires a lot of infrastructure being upgraded or built either within Snowflake or within their cloud service providers, as you said. So they have to spend a lot of money, which lowers those margins.
It's a really good point, Casey. This is why investing in software is so difficult. Even if it's kind of base level enterprise infrastructure, it's such a big market. It attracts lots of competition. And so, that's why we've been saying for over a year now, NVIDIA has leveled the playing field. Anybody can now begin using this NVIDIA hardware. And if you don't want to get left behind, you also have to hop on the bandwagon. So Snowflake has lots of competition. Some of it comes from those cloud providers themselves. Some of it comes from rival software companies that those Cloud infrastructure providers also plug into their ecosystem. For example, Databricks, which gets lots of attention and is a hotly anticipated IPO at some point. So this is ultimately what it looks like, though, for Snowflake. They're taking a hit on their profit margins, and that's just not a great position to be in at this particular stage of the economic cycle.
So that's one issue that we currently have with Snowflake. Let's talk about the other concern that we have, and that's stock-based compensation. This has been an issue for forever, since the IPO. Let's talk more about how this isn't really getting under control just yet.
You can see at every level of the business a fairly high ramp up of stock based compensation in Q1 fiscal 2025. Again, this isn't maybe the penultimate issue like a lot of investors talked about it being during the bear market in 2022 and 2023. But at this point, it is a pretty well broadcast risk because it dilutes per share earnings growth and dilutes per share free cash flow growth for Snowflake shareholders. When you have decelerating revenue and contracting profit margins now, stock based compensation still ramping up at a fairly aggressive rate, more than 20% year over year, ultimately is what stock based compensation increased by. It really, really dilutes the per share profit growth for shareholders. And now you also add in the pretty big increase in capital expenditures. There you can see on the right, in fiscal year 2024, they spent just over 35 million in CapEx. They spent nearly half of that in CapEx just in the first quarter alone, almost 16.6 million spent just in Q1 on those Nvidia and accelerated compute systems. You pair those two things together, now we go back to our base level assumption that we shared back in March. We're not so sure that this 20% average free cash flow per share growth rate over the next 3 years can happen anymore, given that the new competitive environment that has emerged for companies like Snowflake. Unfortunately, it looks like they don't have the pricing power anymore to offset some of these dilutive events. So it's just a tough spot. The business has to do it. I think we can agree on that, Casey. It's not something that they can just say, well, I guess we're just not going to be competitive anymore. We're just going to cut costs. That's not a good solution.
Not possible.
No, that would be even worse. So they're just in a tough spot.
We have this small position that we took a few months ago. We've decided it was too soon. We're going to move on. Let's talk about a couple of other companies that we are going to reallocate that cash to. Those two companies are AppLovin and Monday.com. And now we did do a video on AppLovin recently, and it's been the subject of a thread on our Discord channel. Monday as well, we have not done a video on it, but Nick has put some notes about Monday.com on our Discord channel. Why these two companies specifically, Nick?
Check out the AppLovin video. We paired that one up with Shopify last week, and they are actually, for over a year now, accelerating revenue growth from their AI initiatives. But more importantly, rising profit margins. The market absolutely loves that. You can see what AppLovin is doing with all their profit in that video. As for Monday, this is one that we've actually owned for a couple of years. We nibbled not long after the IPO a couple of years ago, after the stock kind of crashed, I should say, after the IPO bubble crashed. We were content with Monday after the IPO because Salesforce had actually participated in the IPO and then had actually sold their position off at the peak of the cloud software bubble in 2021 and 2022. So after the washout of that, we nibbled on Monday.com. And now we're looking at adding to our position a little bit more. Again, Snowflake, we did not allocate that much money to, just a couple tenths of a percent of our portfolio. It was a placeholder so that we were forced to keep tabs on what's going on. But we're going to reallocate that cash to these two companies because, yes, they're both still growing their sales, their revenue. That's important. But even more importantly, both of these companies have stable or rising profit margins. You pair those two things together, that's exactly what the market is looking for at this particular point. in the economic cycle. And both AppLovin and Monday proven their ability to continue to grow at scale and boost their profitability along the way. Now, Casey, I think we should add this caveat here because we're not adding a lot of cash to AppLovin or Monday.com. We're just going to nibble a bit more on both of these stocks. If you're in doubt, this is a difficult market right now. The market is being very finicky and fickle with software. So if you're in doubt about where to put your cash, seriously, folks, default to high performance ETFs. Our two long-time holdings are here as follows on screen.
Our two ETFs that we hold in our portfolio, the Vanguard Growth or VUG, that is growth stocks in the S&P 500, large cap focused fund. And then the second one, Vanguard Information Technology or VGT. That one is also heavily weighted with large caps, but it does have a fair amount of mid and small caps as well, which could emerge as some of tomorrow's software leaders in that fund. Now, we'll take a look at some of the top companies in these two ETFs in the next two slides. Here's the VUG, that Vanguard Growth. You can see top companies like Microsoft, nearly 13% of the fund, Nvidia, close to 9% of the fund, Apple, Meta, Google, Tesla, all of these companies, large name companies in this Vanguard ETF. And then we have the VGT or the Vanguard IT Fund. Again, Microsoft, Apple, Nvidia, Broadcom, which is one of our top stocks, CRM, Salesforce, another great software company. This one specifically has a lot of mid and small caps that could become leaders in the space.
So there is a fair amount of overlap between these two ETFs in their top holdings, especially the top 20 to 30 holdings. However, if you're looking for your big, stable, large cap and mega cap core, plus getting that long tail of mid cap and small caps that could far outgrow the market and become one of these top 10 holdings 10 years from now, explodes out of nowhere like Nvidia has and has gobbled up a very, very large position in the top 10 holdings. Vanguard Information Technology ETF is a great place to put some money if you're looking for that. Vanguard Growth, VUG, only large cap focused. So a bit more stability as far as that goes. VGT, a little bit more skewed towards capturing mid cap and small cap growth. So again, I think our point here is if you're not sure where you want to put money in software stocks right now, because the market is just doing some wonky things, especially with software names, the market, investors following the money, and a lot of the money is flowing to semiconductors and computing systems and data centers and such. Software, not abandoned and unloved, but it's just gotten a bit wild. If you're unsure, these two ETFs might be a better place for you to focus your attention and learn about. So, not making a recommendation here. We don't know what your situation is, but that's our mode of operation and how we think about this.
Something for our viewers to think about. Now, if you want to have more discussion about this topic, make sure you check out our Semiconductor Insider membership here on YouTube or over on Ko-fi. That gets you access to Discord and all of our manuals and show notes. Make sure you subscribe to the channel and don't miss a video. We have much more coming your way later this week. Appreciate all of our viewers. Thanks so much for watching. We'll see you again soon at Chip Stock Investor.